Silver prices can rise for many reasons, but the more important question is when that rise is likely to end. In this video, we explain the 10 main factors that drive silver prices higher. Not by memorization, but by clearly distinguishing which factors actually determine the trend. Which ones accelerate it, and which ones only affect timing. Because making the right decision in silver is not about guessing the top, but about understanding whether the underlying reasons are still valid. The first and most important factor is demand exceeding supply. This is the core pillar of silver's price. When industrial demand and investment demand rise at the same time, a structural supply deficit emerges. This is not a temporary story, but a long-term imbalance that keeps the primary trend upward as long as it persists. The second factor is the amount of physical silver held in COMEX and Shanghai vaults. If prices rise while vault inventories are declining, real demand is still strong. But if prices rise while inventories start to increase, this is a serious warning that prices are rising without physical demand, something professionals monitor closely. The third factor is the Federal Reserve's balance sheet. When the Fed expands its balance sheet, liquidity flows into markets. Silver typically reacts faster and more aggressively than gold. But when balance sheet growth slows or turns into contraction, the first sharp sell-offs in silver often appear. The fourth factor is the interest rate cut cycle. Expectations of rate cuts support silver, but in many cases, prices rise during the discussion phase and approach a peak when the cuts actually occur, meaning once expectations are fully priced in, the support weakens. The fifth factor is U.S. M2 money supply growth. As money supply expands, purchasing power erodes, making silver attractive both as an inflation hedge and as an industrial metal. But if M2 growth slows or stops, this support fades. The sixth factor is rising U.S. government debt, which does not cause immediate price spikes but gradually undermines confidence in the dollar, pushing investors toward real assets over time. The seventh factor is inflows into physical silver ETFs. Because every dollar flowing into ETFs removes real silver from the market. Continued inflows indicate a healthy trend, while rising prices alongside ETF outflows usually signal distribution. The eighth factor is central banks buying gold instead of dollars, which does not directly increase silver demand but has a strong psychological effect, as gold typically leads and silver follows with more volatile moves. The ninth factor is a short squeeze. When excessive short positions in futures markets are forced to cover, silver can rise sharply in a very short time. But a short squeeze is not a reason to buy. It is often a warning to sell because its effect is temporary. The 10th and final factor is geopolitical risk, which can support silver during wars or global crises, but usually only in the short term, accelerating existing moves rather than creating a lasting trend. In summary, supply and demand determine direction, liquidity determines speed, and derivatives markets determine timing. Silver is not sold simply because it has gone up, but when supply conditions start to ease, liquidity is being withdrawn, and price gains are driven mainly by short squeezes. That is when selling becomes the rational decision. And if you do not want to miss this type of deep cause and effect-driven analysis, remember to like the video and subscribe to the channel. Because success in silver investing comes not from luck, but from disciplined, accurate interpretation.